Warren Buffett, the Oracle of Omaha, has spoken. In his 2025 shareholder letter, he issues a stark warning about the state of the market. This letter, filled with insights and cautionary advice, has captured the attention of investors worldwide. He sees danger on the horizon. The signs are clear to him, even if others choose to ignore them. The market has been on a tear recently. Stocks have been climbing to unprecedented heights. It seems like every day is a new high. But Buffett urges caution. He warns that this euphoria is unsustainable. He believes this exuberance is misplaced. The market's current state is not reflective of underlying economic realities. Buffett's warnings are not to be taken lightly. His track record speaks volumes. He has a long and storied history of successful investing. His insights have guided many through turbulent times. He is known for his sharp mind and his ability to see value where others don't. His perspective is invaluable. When Buffett speaks, people listen. His words carry weight in the financial world. He is a voice of reason in a world often driven by emotion. His calm demeanor provides a counterbalance to market frenzy. The market, Buffett argues, is underpricing risk. Investors are not fully accounting for potential downsides. Investors are too eager to chase returns. They are driven by the fear of missing out. They are ignoring the potential for things to go wrong. This oversight could be costly. This is a recipe for disaster. The consequences of such negligence can be severe. Buffett has seen this before. He has witnessed market cycles and knows the patterns. He knows how it ends. The signs are all too familiar to him. Buffett's letter is a call to action. It is a plea for prudence and careful consideration. It is a reminder that investing is not a game. It requires diligence and foresight. It is about protecting and growing your hard-earned money. Every decision should be made with care. It is about making smart decisions for the long term. Short-term gains should not overshadow long-term stability. Are you prepared for what's coming? The future is uncertain, but preparation is key. Imagine an insurance company. Its business model is simple. Assess risk, collect premiums, and pay out claims. This is the foundation of the insurance industry. Now, imagine this company starts undercutting its competitors. It begins to offer lower prices than anyone else in the market. It offers incredibly low prices to attract more customers. These discounts seem too good to pass up. On the surface, it seems like a winning strategy. Business booms. But there's a catch. This approach has a hidden flaw. This company is underpricing risk. It's not accurately assessing the potential dangers. It's not charging enough to cover potential losses. The premiums collected are insufficient. It might seem fine in the short term. Everything appears stable and profitable. But what happens when disaster strikes? The unexpected can and will happen. A major hurricane, a devastating earthquake, a widespread pandemic. These events are inevitable. They are part of the risk landscape. When they occur, this company won't have the reserves to cover the claims. It will crumble. The financial foundation will collapse. Buffett sees parallels in the current market. He warns of similar risks. Investors, blinded by recent gains, are underpricing risk. They are ignoring the potential for loss. They're pouring money into assets without fully understanding the potential downsides. The allure of quick profits is too strong. They're like the insurance company, riding high on short-term profits but vulnerable to a sudden shift in the tide. The risk is underestimated. This underpricing of risk creates a dangerous illusion of stability. It masks the true volatility. It inflates asset prices beyond their true value. This can't last forever. The bubble will burst. Eventually, reality will set in. The market will correct itself. When it does, the consequences will be severe. The fallout will be felt by all. The stock market is a seductive beast, luring investors with the promise of quick gains and easy money. When prices are soaring, it's easy to get caught up in the excitement and euphoria that fills the air. Everyone wants a piece of the action, hoping to ride the wave of success. Fear of missing out, or FOMO, takes hold, driving even cautious investors to take risks they normally wouldn't. But legendary investor Warren Buffett warns against this herd mentality, urging caution and rational thinking. He urges investors to be wary of overvalued assets, which can lead to significant financial pain. Just because a stock is popular and everyone is talking about it doesn't mean it's a good investment. In fact, the most popular stocks are often the most overvalued, driven by hype rather than fundamentals. Investors, caught in a frenzy, drive prices up to unsustainable levels, ignoring the underlying value. They ignore fundamentals like earnings and growth potential in their pursuit of quick riches and instant gratification. Buffett compares this to buying a house, where careful consideration is key. You wouldn't pay twice the market value just because everyone else is doing it, would you? You would carefully assess its worth, considering factors like location, size, and condition before making a decision. The same logic applies to stocks. Overvaluation creates a bubble that is bound to burst. And like all bubbles, it eventually bursts, often with devastating consequences. When this happens, those who bought at inflated prices are left holding the bag, facing significant financial losses. Their portfolios suffer significant losses, a harsh reminder of the dangers of overvaluation. Berkshire Hathaway, Buffett's investment conglomerate, stands as a stark contrast to the prevailing market sentiment. It's a testament to the power of a long-term, value-oriented approach. While others chase short-term gains, Berkshire focuses on identifying undervalued companies with strong fundamentals. Buffett and his team are not afraid to be patient. They're willing to wait for the right opportunities, even if it means sitting on the sidelines while others are making a quick buck. This disciplined approach has allowed Berkshire to weather numerous market storms and emerge stronger. Risk management is paramount at Berkshire. Buffett understands that losses are inevitable in investing, but he believes in minimizing those losses through careful analysis and diversification. He doesn't bet the farm on any single investment, no matter how promising it may seem. Berkshire's success is a testament to the power of prudence. It's a reminder that slow and steady wins the race. In a market obsessed with speed and speculation, Berkshire's approach is a refreshing change of pace. The economic landscape is constantly shifting. Today, investors face a particularly challenging environment. Interest rates are rising, making it more expensive for companies to borrow money and grow. Inflation is rearing its ugly head, eroding purchasing power and squeezing profits. These macroeconomic factors are creating headwinds for the market. They're putting pressure on corporate earnings and making investors nervous. This uncertainty is reflected in the recent market volatility. Buffett acknowledges these challenges. He doesn't sugarcoat the situation. He knows that the road ahead may be bumpy, but he also reminds investors that this is not the first time the market has faced adversity. It has weathered countless storms before and emerged stronger. For small investors, Buffett's warning may seem daunting, but it's important to remember that you don't need to be a financial wizard to navigate these choppy waters. Buffett offers simple yet powerful advice that anyone can follow. First and foremost, don't panic. When the market tumbles, it's natural to feel afraid. But emotional decisions often lead to costly mistakes. Instead of selling everything in a frenzy, take a deep breath and assess the situation rationally. Remember that market corrections are a normal part of the cycle. They present opportunities to buy quality assets at discounted prices. Instead of fearing these downturns, embrace them as a chance to build wealth over the long term. Diversification is key to mitigating risk. Don't put all your eggs in one basket, no matter how promising it may seem. Instead, spread your investments across different asset classes, sectors, and geographies. Focus on building a portfolio of quality companies with strong fundamentals. Look for businesses with a proven track record of profitability, a solid balance sheet, and a competitive advantage in their industry. Remember Buffett's famous adage, "Price is what you pay, value is what you get." Don't overpay for stocks, even if they're popular. Look for undervalued opportunities where the market has mispriced the true worth of a business. Investing is a marathon, not a sprint. It's about making smart decisions for the long term, not chasing quick riches. Be patient, stay disciplined, and don't let emotions cloud your judgment. Buffett's 2025 shareholder letter is a timely reminder of the importance of preparedness. The market may be riding high now, but storms are brewing on the horizon. By heeding Buffett's warnings and following his advice, you can weather the storm and emerge stronger on the other side. Stay informed about the market and the economy. Understand the risks involved and make sure your portfolio is positioned to withstand potential downturns. Remember, the best time to prepare for a storm is before it hits.